Well, good morning everybody, it's Gerry Hart here. Welcome on this cold February morning to the latest Practical Tax Update webinar from 2020. We've of course had a 2-month gap since the last webinar, so not surprisingly there's plenty to cover today because there's been an awful lot of important developments in the tax world. First topic, extra statutory concession C16, I said on the way out, the final position. Well, it is on the way out because since producing these notes we've learnt that the statutory instrument has been passed by the House of Commons. I don't think any of them really knew what they were doing, and it's coming in on the 1st of March. There's a lot of controversy about this because we knew ESC C16, as for all extra statutory concessions, was going to be on its way out because, as you know, it was deemed that extra statutory concessions, whilst useful, exceeded the powers that the revenue had. Okay, let's move on to my next topic, which is planning for the forthcoming big reduction in the annual investment allowance for capital allowances, to which your reaction might be, well, yeah, we know all about this. We know it's going down from £100,000 to £25,000 from 1st of April this year. So we've given clients planning advice, particularly those clients for whom the £100,000 limit was never really an issue, but the £25,000 limit might be. Well, I'm talking about further planning opportunities that have now arisen, particularly at the last minute, and we are really at the last minute, aren't we? Well, there's still another tax planning tool with the AIA reduction in mind, and that's by reference to using a small self-administered pension scheme to get 100% tax relief on capital expenditure, even if you've gone above what will soon be a £25,000 limit. I'm talking about the loan facility, because a loan can be made to the company to enable it to buy equipment, subject to conditions which are not exactly onerous. First of all, the loan has to be secured as a first charge on the equipment. Secondly, the loan can't exceed 50% of the fund value. Well, my next topic is a topic that we have looked at occasionally over the months of doing these Practical Tax Update webinars. And it is frustrating that for such a fundamental issue of whether or not the revenue can make a discovery, which means inquire into a tax return outside of the normal window of 1 year from the date of filing, is frustrating and worrying, in fact, that there are seemingly regular disputes having to be heard by the courts. And the reason I'm picking this up today is because there are 2 cases recently heard at the Court of Appeal, so they have arguably more credibility, and they do provide some opportunities, which is good. Let's move on and have a brief look at 2 aspects of the relationship between the revenue and its customers, certain customers, i.e. ourselves, because there have been new developments on this. The first one is on service issues, and you may recall, because we touched on this before, that the Treasury Select Committee published a damning report back on the 31st of July last year, which revealed deep dissatisfaction on the part of tax advisors with the service provided by the revenue. Not surprisingly, therefore, it was that conclusion, but also that the revenue had to take this seriously, and they invited representative bodies to a meeting, and they said as part of the stage of building a new relationship on service issues, they agreed the following 3 initiatives, and they've been developed.